The current financial crisis hit hard back in 2008, near the end of a grueling election year and in the final months of the Bush presidency. The crisis brought about a level of government involvement in the financial system not seen since the Great Depression, involvement that has been highly criticized on both ends of the political spectrum. So what actually happened on Wall Street? Why did the government get involved in the way it did? And most importantly, are we taking steps to ensure that this sort of crisis doesn't hit again? We'll answer these questions and raise a few more as we look at what was going on, meanwhile, in Washington. So first and foremost, I should introduce myself. I'm David Wright, and I'm a student currently studying film, which begs the question, why should you be listening to me? I'll be the first to admit I don't have the background for the financial markets, but I believe that this is an important issue and one that is not very clearly understood even today. I've done my best to educate myself on the issue, and this is my attempt at making it easier for the rest of us who don't have a career on Wall Street to understand it. After all, if I can comprehend any of it, odds are you can too. To that end, I sat down with two experts. One, a professor of economics at New York University, Lawrence J. White. Professor White is co-author of Guaranteed to Fail, Fannie Mae, Freddie Mac, and the Debacle of Mortgage Finance. The other is Joshua Bolten, the former White House Chief of Staff under George W. Bush, also a former employee of Wall Street giant Goldman Sachs, and current professor at Princeton University. What would you say caused the financial crisis?
Now you're asking a complex question, believe it or not, that really requires a complex answer. I think the place you have to start is with the housing bubble.
For almost a decade, we had housing prices just going perpetually up. And everybody, including a lot of economists, but certainly the banks, made the mistake of assuming that housing was always going to go up.
And somehow, for reasons that I don't fully understand as an economist, the belief grows that housing prices can only go up. And if housing prices can only go up, then mortgages are never going to be a problem. This then gets compounded by the fact that, given this belief, we have mortgage lenders starting to lend to borrowers who are less creditworthy.
And if everybody thinks housing prices are constantly going up, then what's the risk in either taking on a lot of debt to buy a house, because the asset you bought is always going to be more valuable a year from now than it is today, so worst comes to the worst, you can sell it for more than you bought it for and pay off your debt. And there's relatively little risk to the bank in making a loan to somebody who otherwise isn't particularly creditworthy, because worst comes to the worst, they can foreclose on the house and get more for the house than they originally loaned money on in the first place.
This came to be known as subprime lending. Contributing to the subprime lending were the credit rating agencies, who were willing, again because they drink the Kool-Aid of housing prices can only go up, credit rating agencies give high credit ratings to the securities that are formed from these subprime mortgages.
Mortgage-backed securities are groups of home loans put together and sold as a bundle. They are created when a bank gives out a bunch of home loans, then sells them off for a price. The bank gets immediate money from the transaction, and the person or group that purchased the mortgage-backed security will make money for as long as people continue to pay back the loans on their house.
We have Wall Street investment houses that are securitizing these things, that are selling them to investors, that are investing themselves. They contribute.
As you can see, Wall Street clearly lost some touch with reality when it came to trading the mortgage-backed securities. A good illustration of how absurdly optimistic Wall Street was is the Gaussian copula function, a mathematical formula that was widely used to determine the value of mortgage-backed securities based on how much people were willing to, in essence, insure them for. This model did not take into account what would happen if housing prices ever started to fall and was not based on any real-world data. Instead, it simply assumed that if the price of a credit default swap, or the insurance, had risen, that meant the risk of people defaulting on their payments in the mortgage-backed security was greater. This made the faulty assumption that the people who priced the credit default swap were accurately gauging the risk of defaulting in the collection of mortgages. They weren't. Thus, when housing prices began to fall, the flaws in the Gaussian copula function became apparent, and a lot of people suddenly found themselves out of a lot of money. These are the toxic assets we've heard so much about. Securities that lost value when housing prices declined. Looking back on it, at least some on Wall Street admit they were a little trigger-happy when it came to trading securities, although many believe they have been unfairly maligned for their role in the crisis.
I might get a little trigger-happy with that, depending on how much it's insured for. But again, if something's going to be insured, it should be, covered. Like if it's going to be insured, there should be money to back the insurance. And again, anything that's insured on Wall Street is considered a better investment because if something were to happen with the underlying investment, the insurance will cover it. And again, that's when you have such improper lending on such a massive scale, I don't care how big of an insurance company you are, you can't cover it. It's not going to happen.
Adgar Repko works for a comparatively small investment bank on Wall Street called Spartan Capital Securities, LLC. I met him outside the New York Stock Exchange, and he agreed to answer a few questions about Wall Street's involvement in the crisis on camera. You feel that there was lying on the part of the credit ratings agencies, and that I was under the assumption that by putting all the collateralized debt obligations together, that you'd get something safer, and that's what made it AAA. You think it was dishonesty?
No, it's dishonesty without a doubt. I mean, if you don't look into the records of the people that you're actually lending money to, and you don't honestly look at their credit scores, and you don't actually take into account that someone who's making 20 or 30 grand a year can't afford a $500,000 house, you shouldn't be giving them a loan for it. When that's not taken into account, and these CDOs are given out regardless of that fact, unbeknownst to anybody else, and packaged other AAA rated securities, how am I supposed to know? How am I honestly supposed to know that Joe Blow out in Wisconsin, who's buying a $500,000 home, is only making 30 grand a year? I have no idea. I have to go on what the banks tell me. If the banks are lying to me or lying to the public, it's the same thing.
Mr. Repko makes a good point when he says that the ratings agencies weren't doing their jobs properly. But it's difficult to tell if there was any dishonesty from them. While it's true that they were often closely associated with the companies that were making money off them, therefore giving an appearance of impropriety, they also seem to have often made the mistake of thinking that bundling a bunch of unsafe loans together would make the end result safer, which it did not. I do have to take exception to Mr. Repko's defense of Wall Street, however. Just because the credit ratings agencies weren't doing their jobs properly doesn't mean that the people on Wall Street are relieved of responsibility.
If you look at the savings and loan crisis that happened in the late 80s, early 90s, every major president that's been in office since then has made reforms in Congress that caused the collapse that happened as it is.
The argument that Washington facilitated the crisis by encouraging home ownership has been around for a while now, and is one of many controversial opinions on what may or may not have influenced the crisis. Josh Bolton believes it didn't.
I think it was a minor contributor, the government policies of promoting home ownership, which put pressure on banks to make loans to folks who might, without that pressure, not have gotten loans from the government. But I think that was a relatively minor contributor to the housing bubble that built up.
One specific act that Mr. Repko mentioned to me was the Community Reinvestment Act of 1977, or CRA, which encouraged banks to make housing loans in moderate to low income neighborhoods. Many on the conservative side of American politics have argued that this forced banks to make subprime loans and therefore caused the crisis. The Federal Reserve, which has often been criticized for being too close to the banks, and the Federal Deposit Insurance Corporation have both found this claim to be false. The amount of subprime lending that occurred before the crisis hit was so great that the government couldn't have caused it even if it wanted to. The facts are simple. Bundling and selling mortgage-backed securities was profitable, so banks made a lot of subprime loans regardless of what the government wanted. This isn't to say that the government, as well as organizations associated with the government, weren't involved in the build-up to the crisis. Fannie Mae and Freddie Mac, publicly traded companies founded by the federal government, arguably made the crisis worse than necessary.
Fannie Mae and Freddie Mac contributed, though they were not directly part of the subprime part of the mortgage market. Still, during the late 1990s and especially the middle of the first decade of the 21st century, their lending, they bought mortgages. They didn't directly do the lending. They bought mortgages from the lenders. Their standards declined, which again contributed to all of this.
It's worth mentioning that in 2006, roughly 83% of subprime home loans came from private institutions, meaning that less than 20% could have come from Fannie and Freddie. While that number is still significant, it is incorrect to blame Fannie and Freddie for the financial crisis alone, as some on the right have done. Thus far, we've mostly talked about areas in which Republicans were wrong, but the Democrats were wrong on many things too. For instance, many Democrats didn't see the dangers of Fannie and Freddie trading mortgage-backed securities. That was foolish. The other area in which Democrats were wrong is twofold. First, they allowed the repeal of the Glass-Steagall Act, and second, they then placed too much weight on the repeal of the Glass-Steagall Act in causing the crisis. The Glass-Steagall Act was passed in the wake of the Great Depression and prohibited commercial banks, which rely on stability, from also being investment banks, which thrive on risk. It was repealed in 1999 by a separate piece of legislation which also specifically made it possible for commercial banks to own subsidiaries that engaged in trading securities. Thus, it enabled more trading of mortgage-backed securities, which was arguably the biggest factor in causing the economic crisis. And it allowed banks to grow bigger, some of them arguably growing too big to fail. Certain economists on the left, such as Nobel Prize-winning economist Paul Krugman and former chairman of the Federal Reserve Paul Volcker, believed that the repeal of the Glass-Steagall Act was a mistake, and that it played a large role in causing the financial crisis. Other economists, such as Professor White, disagree.
Now, there are some people who will try to tell you, it was the erosion of the Glass-Steagall barriers that was a major cause of the financial crisis. I think this is a total misunderstanding.
While the professor disagrees with my assessment, it seems clear to me that the repeal of the Glass-Steagall Act did not help the economy. And had it still been around when the housing bubble burst, we might have been better off. Still, if such vehement disagreement exists among economists, it seems clear to me that it couldn't have been the major cause of the crisis, and anyone who says it was is simply wrong. Having discussed the causes of the crisis, we can now look at what was going on when the financial crisis finally hit home. The first bank to start failing was Bear Stearns in March of 2008.
The Treasury, the Federal Reserve, looked at that and said, we're really worried that if Bear were to declare bankruptcy, Bear is so interconnected with other financial institutions that if Bear goes down, Bear can't honor its obligations, then there could be a cascading effect. Others can't honor their obligations, and suddenly we have a mess on our hands.
I think probably the Bear Stearns episode in early 2008 was the first occasion in which official Washington really took cognizance that there might be some broader systemic problem in the financial system. Even then, though, it wasn't clear that it was much more than Bear Stearns specific.
And so it was basically the Federal Reserve taking the initiative in March of 2008, arranged for Bear to be absorbed by J.P. Morgan Chase.
In George W. Bush's memoir, Decision Points, Bush recounts that after finding a buyer for Bear Stearns, he thought the financial crisis was over. Then came Lehman Brothers, 5 months later.
Lehman is a almost $700 billion asset investment bank, thinly capitalized. And Lehman is suffering a run. Lehman is suffering the lack of confidence on the part of its creditors. And at this point, the Treasury says, now look, we did help Bear Stearns get absorbed by J.P. Morgan Chase. That was in March. It's now September. The financial markets have had 6 months to come to terms with the fact that, these guys may experience difficulties. If you're a creditor, you ought to be protecting yourself. We have to draw the line somewhere. We're going to draw the line here.
Bernanke, Geithner, Paulson were unanimous in the view that they didn't have any measures to recommend to the president to rescue Lehman. And therefore, they had no choice but to let it fail.
Knowing what I knew then, what I think the Treasury people knew, I would have made the same call based on the same information. You got to draw the line somewhere. This is the place to draw it. Well, within about 24 hours, maybe 48 at most, we all realized what a mistake that was.
After Lehman Brothers failed, AIG started to go down too. It was at this point that President Bush and his Secretary of the Treasury realized that the problem was not limited on a bank-by-bank basis. The problem was systemic.
Lehman failed, and we thought, well, that's it. It can't get worse than this, and within a few days of Lehman failing, AIG was going down.
The financial markets weren't prepared. That, in fact, they had seemed to believe that somehow, whether it was, magical thinking, I don't know, but that bad things weren't going to happen, but they did happen. Suddenly, the financial markets have frozen up. Nobody wants to lend to anybody else. There's this great uncertainty who's solvent and who is not, which means who can pay me back if I lend to them and who can't. And the most important question of finance is, will I get my money back? And if I lend, and suddenly there's this great uncertainty. At that point, we have a full-fledged crisis on our hands.
The executive branch did what it could at the time. It issued a rule that temporarily disallowed short selling.
The reason they disallowed it was a perception from some participants in the market that there were short sellers taking advantage of the crisis situation to drive down the price of shares of financial institutions in particular.
It also insured $3.5 trillion in money market mutual funds.
Up until that time, most people thought of money market funds like a deposit in a bank. If you give $100 to a money market fund, it's gonna grow at a modest interest rate, but you're always at any moment going to be able to get your $100 out at a minimum. $100, and that's why people put money in money market funds rather than stocks or bonds or something like that. And it's a many trillion-dollar market, both for large institutions and especially for individuals. And for the first time, a money market fund had demands on its funds and was unable to pay a full dollar return for a dollar deposited with a money market fund. And had people lost faith in their deposits in money market funds, there would have been a radical and immediate exodus of money from those funds, which would have accelerated and deepened the spiral down in the collapse of the financial system.
It quickly became apparent to many in government including Treasury Secretary Paulson, that congressional action was needed. Thus, the Troubled Asset Relief Program, better known as the TARP bailout, was created.
It was a very undesirable resolution from the president's standpoint to be bailing out the banks that most people thought had caused the crisis in the first place. But it seemed like the only dramatic step that could be taken that would end the crisis of confidence. So plenty of options were considered, but a broad-based financial support to the banks from the federal government ended up being really in some respects, our first and last best and least desirable but best choice. And in the end, it worked.
It was intended to stabilize the financial system. And yes, in that sense, it was successful.
Now, make no mistake, the bailout was needed. The economy, and by extension America and the world, would have been in deep trouble without it. But, and this is just my personal opinion, I don't feel like the government was very honest about it, though they did have a good excuse. The purpose of the bailout was to put confidence back in our financial system.
The entire economy has not recovered, but the one thing you do know is that the entire economy would be in much worse shape if the financial system had collapsed. And the goal of the TARP was to prevent a collapse of the financial system.
If government officials had gone around saying that we needed to pass this $700 billion bailout package in order to instill confidence in our economy, it would have had the opposite effect. And so what we were told over and over was that we needed this to save our economy, which was true. But many, myself included, thought that this meant saving things outside the financial sector a little more readily. Some even suggested just paying floundering homeowners, then they could pay back the banks and the toxic assets would no longer be toxic. But this wouldn't have fixed the problem of confidence in our financial system, and so that plan was scrapped.
The original vision that Mr. Paulson had enunciated was that the funds that were authorized by TARP were going to be used to buy the bad assets out of the big financial institutions that held them. So they'd be replacing the bad assets with good assets, cash. Then the Treasury would manage the assets. There would be some losses experienced, but by replacing the bad assets with good assets, we would recapitalize the financial system. We'd get the financial system functioning again. In principle, I'm one of the few people who think that wasn't a bad idea. But Mr. Paulson didn't express it very clearly, didn't convince very many people. I mean, he was able to get the legislation, but he didn't actually have a working program ready to go. And about 2 weeks after the legislation was passed and signed by President Bush, the British had a completely different program for their banks, where they basically just threw money at the banks. They recapitalized the banks by just throwing money at the banks. And somehow everybody said, oh yeah, that's a great idea.
In the end, the way TARP was handled has had mixed results. On the one hand, we're actually making a profit on the loans that we gave to the banks through interest. On the other hand, aspects of the legislation that were intended to help Main Street have been neglected. Former Special Inspector General of the Bailout Program, Neil M. Borofsky, recently wrote in an op-ed that the program to modify mortgage agreements to help struggling homeowners has been a colossal failure, and that there was no effective policy or effort to compel the extension of credit built into the loans given to banks by the federal government. The result has been a quick recovery from this recession on Wall Street and lingering economic uncertainty on Main Street. So, where does all this leave us now? Well, we didn't want to attach strings to the money we gave to the financial sector in the bailout because doing so might have weakened it further, and therefore would have caused us to lose even more confidence. But after the fact, we did pass the Frank Dodd Reform Act.
Dodd-Frank was a step in the right direction. There's lots of things about Dodd-Frank I don't like, but it was a step in the right direction. But the clear message, more capital, and a tax on business, both of those things, they needed to be there, and they weren't.
Well, we still have a lot of work to do. To that end, I've compiled a list of policy decisions I believe we should make that would prevent a crisis on this scale from occurring again. First and foremost, there was a law that was passed in 2000 called the Commodity Futures Modernization Act, which I believe should be overturned. It exempted derivatives, including credit default swaps, from regulation. Even though the government and the financial industry are working together to clean up the trading of credit default swaps, there's no good reason to not allow regulators to have more control over these volatile financial instruments. Further, while Professor White will disagree with me for saying this, I believe we need to reinstate the Glass-Steagall Act and update it so that it includes the trading of securities. Where I do agree with Professor White is simple. Tax the big banks more.
This was an idea that got floated by the Obama administration, my memory is in early 2010. And that is, basically there ought to be a tax on size, because it's big institutions that really were the ones that got us into trouble. It's the big institutions that are systemically important if they are risky. Well, in the language of an economist, being big and risky is a negative externality. It has negative consequences for the rest of society. And as an economist, we know how to deal with negative externalities. Put a tax on it.
Understand that I'm not mentioning these proposals thinking we can up and institute them tomorrow. The political will just isn't there anymore. We missed that chance when everyone was angry at Wall Street and we had to bail them out. Now, I understand why we didn't pass new regulation at the time. We didn't want to spook the markets further. But it was a missed opportunity. It was our only real chance to change anything that really mattered. So no, I'm telling you these proposals so that the next time a crisis hits, and our boom and bust economy guarantees it will, you know what to tell your representative that might actually prevent the next crisis from occurring. Because only after another crisis will we have the opportunity to make the economy work the way it really already should.